Hello, and welcome to this week's episode of Coinscrum Markets. I'm Nisa. Coming up, I speak to Jeremy Allaire from Circle and Garrick Heilman from Blockchain.com about the rise of the digital dollar, and Mike Moro, CEO at Genesis Trading, about his company's recent expansion into prime brokerage for crypto traders. Jesse Proudman joins Teana to discuss the much debated Bitcoin stock-to-flow model in crypto RRQ. And Philip Gradwell from Chainalysis is back for his regular review of this week's on-chain data. First, a look at this week's blockchain industry news. Crypto assets got another major endorsement this week when the former chair of the National Futures Association and derivatives trading veteran, Chris Haymeyer, announced that after 40 years trading in the traditional derivatives markets, his firm is now exclusively focused on providing liquidity to institutions for Bitcoin and other digital assets. The recent excitement surrounding DeFi projects suffered a setback this week when Balancer, an automated market maker protocol, saw 450,000 worth of assets drained from two of its automated liquidity pools when a hacker exploited a flaw in one of the platform's smart contracts. With four similar high-profile attacks having already occurred this year, it seems that the nascent industry still has some way to go to deliver the level of security and recourse expected of their centralized counterparts. The European Union's economic minister said this week that its regulators had to seize the opportunity to become one of the main rule makers for digital finance, specifically citing cryptocurrency and global stablecoins as most in need of a consolidated regulatory approach across the continent, but within an environment that supports experimentation and innovation. The dispute between messaging app Telegram and the SEC over the company's $1.7 billion token sale in 2019 seems to have reached a conclusion, with the firm agreeing to pay $18.5 million with a commitment to return a remaining $500 million still due to investors within 3 years. Finally, the People's Bank of China says the use of central bank digital currency will help monitor and control the flow of capital outflows by individuals trying to smuggle yuan out of the mainland to acquire Hong Kong or US dollars, the same reason that many assume to be the cause of the country's clampdown on Bitcoin exchanges back in 2017. Next up, crypto RFQ.
Thanks, Nisa. I'm joined today by Jesse Proudman from Strix Leviathan. Hi, Jesse. Thanks for joining us today.
My pleasure. Thanks for having me.
Great. Today's crypto RFQ is going to be a little different than some of our previous versions. Bitcoin's been trading at a relatively tight range between $9,000 and $10,000 since the halving, and traders are probably going to break one way or another. For those viewers that aren't aware of it, a Twitter commentator that goes by the name of Plan B last year published what he called the Bitcoin stock-to-flow model. And it was jumped on by a large swath of Bitcoin hodlers as a guaranteed vision of the future. So that was no doubt helped by the fact that it forecast another soon-to-come price increase. Jesse, you're not a fan of this Bitcoin stock-to-flow model. Can you tell us why, and why do you think it's flawed?
Yeah, absolutely. So we're big believers in the need for fundamental valuation models in this space. I think most people have approached this space as a speculative asset, as a speculative investment, and they follow sort of other traders. Fundamental valuation models try to put some future price on some fundamental item or element about a coin. Yeah. The problem we have with the stock-to-flow model is that effectively the theory behind it, it's not a theoretically valid theory, and then the math behind it is not valid. And so what you end up with is a model that projects Bitcoin to be $100,000 this year, and upwards of sort of $245 billion per Bitcoin as the model plays out over the next 40, 50 years. And so it's a marketing model more than anything else in our eyes. And it's disingenuous. It attracts people to invest in this space for the wrong reasons. Like, we believe this is an interesting asset class. We believe the price will go up over time, but we want people to invest for the right reasons, not because they're following a model blindly that is not theoretically valid.
Right. Okay. So is there any merit to the model when, he's talking about applying it to gold and silver?
Yeah, it's a good question. So the model itself effectively is trying to say that you can map out the value of Bitcoin using this ratio of the stock on hand, how many coins are already on chain versus the new stock that's created, the flow, effectively how many coins are mined in each block. And he's built this mathematical model that maps that over the history of Bitcoin, and then tries to use gold and silver as two examples of that in other metals that have similar characteristics to Bitcoin. Whereas the new coin or the new commodity that is mined doesn't have a significant impact to the existing stock on hand. And the challenge is when you actually look at the data for gold or for silver over the last 150 years, stock to flow, the valuation models for those is all over the place. It's an $8 trillion range. So there's not sort of a predictive characteristic in gold that you can use with these values. And so in our eyes, right there, you can't necessarily take that model and try to apply it to Bitcoin if it doesn't work in other assets.
Okay. So the Bitcoin hype cycles, especially since the halving, have seemed quite cynical, right? I think some of us expected that, it was going to generate this fever. It stayed pretty stable. And, I use that word kind of loosely, but I mean, really hovering between that 9 and 10, it's pretty stable. It usually, has more movements than that. So, is there a way that you can look at this stock to flow model and justify that forecast for different reasons?
Yeah, it's a good question. I mean, I think the halving has always been looked at as this really fundamental point in the history of Bitcoin. And the challenge is that there have only been 2 prior halvings to use as evidence of what's going to happen. And so following both of those halvings, we saw pretty dramatic rises in the price of Bitcoin. Certainly it took time for those rises to materialize. I think a lot of people look at the halvings and they think pretty simple sort of supply demand economics. So if demand stays constant and supply is cut in half, in theory, the price should rise. And the stock to flow model follows that to some extent. But there's a lot of realities with this particular halving around the institutionalization of mining that haven't occurred in prior halvings, right? The amount of money that has been invested into data centers, into equipment, into power contracts, the tools these miners have between futures contracts and options contracts and lending markets to be able to hedge their positions. All of these are things that didn't exist in the last 2 mining cycles, the last 2 halving cycles, I should say. And it's those things that we believe really are impacting the price now. So we're neither sort of bullish or bearish on this particular cycle. Like the price will go where the price goes, but I think you have to realize that this halving is very different than the last 2, and that 2 prior data points don't necessarily map out to predict this existing halving.
So what do you think that the lack of action since the halving tells us? That, we're queued up for a sharp price increase, or?
I mean, I think this is a speculative market, and speculative traders go where there's the most action. And if you look over the last 2 months, that's been the stock market. The stock market has lost all grounding in reality, and it's being really treated like sort of crypto alt markets. Like things don't make sense, and the price action there is pretty crazy. And so that's where I think you're seeing the bulk of retail traders. That's where you're seeing the bulk of speculative traders. And until the stock market calms down and gets back to some semblance of sort of traditional normalcy, whether that's logical or not, I think we're going to continue to have some challenges with limited volatility in the crypto space.
Well, that's really interesting. I just had a conversation earlier with a regulator that is focused on crypto assets, amongst other things, but we were talking about crypto assets. And he was saying that, he's watching the traditional markets, and crypto is the least of his concerns at the moment. And he is wondering where all these retail day traders are coming from on the likes of Robinhood, et cetera.
Right. I mean, just look at Hertz, right? Like the Hertz bankruptcy and issuing another $1 billion of stock. I mean, these are straight out of crypto storybook, yet they're happening on the traditional financial markets. And so that's where, in our eyes, sort of the speculative traders that push price around in this space, that's where they're playing today, because that's where the returns are.
Okay. Well, Jesse, thank you very much for breaking that down for us. I learned something today, which is great. And hopefully we'll have you back in a couple of weeks, and maybe we'll check in with you on where that Bitcoin price is then.
Great. Thanks so much for having me.
Thanks again.
Welcome, Michael. Good to have you back.
Thanks for having me.
Genesis started its Bitcoin OTC desk way back in 2013. And what did a Bitcoin trading desk look like then? And how are trades executed and settled?
Back in 2013, as you might imagine, we were early. Many people will tell you we were too early. As the price of Bitcoin was around $80 when we first started kind of getting involved, and we had, through the same desk that we're currently trading Bitcoin, traded fixed income securities. We were bond traders initially, trying to kind of trade another illiquid, off the run financial asset. Like Bitcoin, I wouldn't say was completely foreign, although the fact that we had to set up our own wallets and get that set up as opposed to relying on, Pershing, which was our clearing broker dealer on the security side, was certainly different. The bigger shock, I think, was for the participants in the ecosystem at the time. As you might imagine, it's not too long since kind of the birth of Bitcoin that we got involved, and many of the earliest adopters of Bitcoin were the anarchists and the libertarians, and certainly kind of following the financial crisis and the Occupy Wall Street movement. And here was a Wall Street regulated broker dealer trying to break into Bitcoin and create a marketplace to bring institutional investors. And so certainly there was a lot of interesting stories at the time of walking clients through what an AML KYC process was, and why we needed to run background checks, and why we needed to collect IDs and things like that. But certainly those were the sellers. Those were the guys that had a lot of Bitcoin, and who might have bought it for a few dollars, and here they had a chance to kind of sell it for $80, and they're like, great. We didn't have too many institutional accounts getting involved. It was mostly high net worth. That was based out of Silicon Valley, who just wants to take a flyer. And maybe it becomes something, maybe it becomes nothing. So that was really the kind of environment back then. Really, really, nascent, immature, and incredibly illiquid.
Well, things have clearly moved along, and now you're one of the leading lending desks, and you've recently moved into prime brokerage. And the March sell-off in the market was the first big test in terms of risk management. How did you cope with that?
So we launched our lending business in March of 2018. So it's now just over a couple of years now since we've been doing this. And frankly, we launched our business kind of right at the start of the crazy bear market, right? Following the bull run in 2017, 2018 is the ultimate bear market. Which lasts, and you can arguably say that we're still in a prolonged bear market kind of since then. But the companies we started lending to in 2018 had been around for a few years. And frankly, when we got larger and grew our business last year in 2019, it meant a lot to us that each of these businesses survived 2018. So these companies managed to survive where their core asset fell by 85%, 90% plus, which told me that their risk management systems were in place, that they understood risk and reward and when to go for it and when to back off. And it gave us a ton of comfort on the underwriting side that these weren't amateurs, and that they had systems in place. Now, when March 12, March 13 kind of comes around, and frankly, the volatility had started in other markets before March 12, 13 hit. If you remember, right at the start of that week was kind of the first OPEC oil crisis with Russia and production sending oil volatility down,
right?
Which sort of spilled over into the equity markets and the bond markets selling off. And when in times of crisis, we all know correlation goes to one. And so we had our antennas up for sure, so that something could happen in Bitcoin. Now, the magnitude and the speed at which the liquidations and the sell-offs kind of started on that Black Thursday, that's something that we obviously, couldn't be ready for or certainly kind of expected. But what certainly helped was, one, we only lend to about 30 to 40 counterparties. So it's a manageable number of folks to reach out to and kind of communicate with. And frankly, almost all of them we have a trading relationship with. And so we're in constant communication with them throughout the day anyway on the trading side of the business. And so, when the lending guys wanted to talk about, hey, how do you want to handle this loan regarding additional collateral or calling for additional collateral, or maybe they wanted to close the loan, the communications were really seamless. And so while it was operationally very stressful, as you might imagine, from folks looking to take on more loans, from folks posting more collateral, from folks closing loans. And as you recall, the Bitcoin blockchain was quite full. And so we had trouble, like even just sending and receiving coins because they were just not getting picked up in the Bitcoin blocks. And so there was certainly kind of slowness and nervousness. But at the end of the day, we still had no defaults, no forced liquidations. And everything, once the dust settled, things looked just like we had hoped and prayed when we set and designed up all of our risk systems. And so it was certainly a tremendous stress test for the business and the systems, but also for our people to be able to kind of get through it.
Yeah, that's great. So you recently announced you acquired UK-based custodian Vault, and you're also working with Fireblocks as a vendor. Tell us, why them, and what makes you decide what to build tech in-house or what to outsource?
So, we've been fairly methodical in the way we've built Genesis. As you mentioned, we started trading in 2013, and frankly, that's all we did for the first 5 years. And then we dipped our toes into lending in 2018, and that's the business has grown far, far beyond my personal expectations for what the business could be. But we've always kind of built products and services hey, what's this equivalent in the traditional market? If we're really kind of trying to woo the big traditional investors that are in stocks and bonds and commodities, what services, what companies exist in that world that is missing in crypto? And so we started kind of talking internally and strategizing about being a crypto prime broker a couple of years ago. We started saying, what are we missing? And the first obvious answer was custody. We had been non-custodial up until that point, but you couldn't really call yourself a prime broker if you couldn't hold your client funds. And so we debated internally the build versus buy strategy. We had created budgets about how would we do this internally, not just kind of hardware, but people we would need to employ both on tech and operations to do this. And we thought about partnerships. Can we work with somebody that exists in the ecosystem today that is a custodian? And can we just set up a partnership arrangement with them where they could be a sub-custodian for what Genesis clients may ultimately want to hold? The conversations with Volt really kind of started last fall, so the fall of 2019, when we said, hey, we're looking at different alternatives and paths, and so were they. And so the initial kind of conversation about maybe partnering up through an acquisition was sort of brainstormed late last year. And we really kind of did the diligence part in January, which was incredibly timely because obviously COVID set in just a few months later. And the ability for us to conduct on-site diligence was incredibly important for us and to be able to meet the team. And so, through, we've known the Volt team for a couple of years, and we've worked on them on a number of different projects with them. And so we knew the management team, we knew the product, we got to know the tech stack in January. And so it certainly made sense as kind of our best path forward to acquire the business rather than try to, do it on our own.
Mm-hmm. And what about Fireblocks?
So Fireblocks as an interesting dimension, the way they've always kind of pitched the business is great. You have a wallet A and you want to send it to wallet B. A and B might be incredibly secure, but how do you get there? The time of sending the transmission of the coins and the transaction between point A and B might be insecure. How do we create a secure gateway so that nothing can happen to the coins while they're in transit? Mm-hmm. And because we move coins around so much, and on our lending side, we currently have about $1.4 billion in our loan portfolio as we sit here this morning. And we're originating so much volume that securing and making sure the coins movement part was safe certainly made sense. And so Fireblocks kind of certainly helps us out to give us that peace of mind that the coins are okay while in transit as well.
Great. So it seems like everybody's jumping into prime brokerage in the last 2 months. When do you expect traditional prime brokerage entrants to enter, or do the scars need to be earned by these entrants? And how do you anticipate competition working out here?
It's funny. Had you asked me in 2013 when the traditional primes would get involved, I would have probably said probably about 5 to 10 years, right? And we sit here in 2020, 7 years later, and I still feel like they're 5 to 10 years away. In that they've certainly done their homework, and I think they follow the asset class, but I don't really think they're close. Certainly because the largest primes are still the Goldman Sachses and the JP Morgans of the world, who have certainly dipped their toes with various derivative products and stable coins and things like that, but haven't really kind of gotten their hands dirty in the asset class itself and touching the coins. And I still feel like they're certainly a few years away from getting involved. And frankly, it might be easier to acquire an existing crypto prime broker, frankly, than to build something in-house and try to do it themselves.
Right. And we know how Goldman Sachs feels based on their research.
At least one section of Goldman Sachs, yes.
Yes. Okay. Well, great. Anything else we can look forward to from Genesis in the next coming months?
Yeah, I mean, the acquisition of Volt helped to kind of spearhead international expansion plans for us. And so we, once the COVID situation subsides, we'll be populating a London office as a result. And in January of this year, we started filing paperwork for our presence in Singapore. Mm-hmm. And so in the coming months, you will see New York, London, and Singapore as hubs for various Genesis Prime activities. And given that crypto never sleeps, having 3 different office locations scattered around the world certainly makes sense from a time zone coverage. And we'll continue to roll out products and services that traditional prime brokers provide in the space. So we announced derivatives just a few weeks ago. So we're now actively making markets and over-the-counter options. And we'll get into areas like capital introduction and things like that towards the end of this year.
Fantastic. Well, we're looking forward to your continued success and congratulations.
Thank you very much, Nisa.
Thank you. Welcome, Jeremy and Garrick. Thanks so much for joining us. The value of all stablecoins and issuance recently surpassed the $10 billion mark and trebled since the start of the year. We started out with fiat-backed tokens to support crypto trading and evolved to payments to trading of non-digital assets, and now we're talking about the digital dollar in the Senate yesterday. What has accounted for such rapid growth? Jeremy?
But it's been really interesting. We've seen with US dollar coin, USDC, since basically correlated pretty closely to the outbreak of the COVID pandemic, a pretty dramatic growth in every major metric around the center USDC stablecoin. So we've seen the amount in circulation grow by well over 100%. To it's just a hair shy of 1 billion USDC in circulation. We've seen the amount of issuance and redemption overall, so people kind of using it as a rail coming in and out, growing very, very fast. And then, other metrics like the number of wallets using it, on-chain transaction volumes, all these have continued to move pretty steadily. And it correlates, the correlation to COVID, I think, is striking in a few ways. So I think the first is we obviously saw with the outbreak, the sort of global economic crisis unfolding as well, and a rapid shift into dollars as a safe haven asset, a historical safe haven asset. And digital dollars are in some ways also they're also a safe haven asset, although they have some attributes that I think make them particularly attractive in global markets. When you think about a dollar today, if you have a dollar in a commercial bank account, that's a fractional reserve dollar. So it's a dollar that is, being lent out over and over. And so if you have questions about, say, the potential for solvency risk in households or firms, and in turn, what that might mean for solvency risk of financial institutions, the fractional reserve money is challenging. We've seen that in multiple crises. So we've sort of staved off a financial crisis for now, but as this unfolds, there is that risk. And I think it's very easy when we think about dollars to think about, oh, well, I've got Bank of America or I've got a Chase account. That's the United States. Dollarization is a global theme. It's about Latin America, Africa, South Asia, other parts of the world where they do not have the firepower of the Fed. They do not have the fiscal means to counteract the incredible destruction that the pandemic's having on their economies.
So, Garrick, you just published the first part of a 3-part paper on the digital dollar, where you talk about the change in sentiment from central banks towards the idea has been very rapid. And we know that Libra was a starting gun and has been fast-tracked by COVID. But you also say that most people don't understand the difference between commercial and central banks. Can you talk a little bit more about that and your article?
Yes, thank you. Commercial bank money and central bank money has been a challenging topic for, I think, many people to understand for as long as I've been teaching. I mentioned, that I bring this up regularly over the last 10 years in lectures to executives in financial services companies, even who understand that, the coins in our pockets, the banknotes in our pockets are minted by central banks and governments, but don't appreciate how much of the total money supply is actually manufactured by commercial banks when they make loans. That is where the vast majority of money comes from. And so there's a real economic education gap, around the topic of money, which has, been a huge challenge for helping people to understand crypto assets like Bitcoin through the years, but also is going to be a huge challenge for engaging the broader general public on this question of a digital dollar, kind of an expansion of central bank digital currency. We already have central bank digital currency. It's just not widely available to people like me in the streets. Commercial banks and foreign governments get to hold accounts at the New York Fed, but I can't walk in and set up my own personal bank account at the New York Fed like maybe I could with a digital dollar. And that's, I think, a huge issue. Like, how well understood is this issue, not just across the general public, but as we've seen, and Jeremy can attest to this, I know he's gone in front of Congress, we've got a technology challenge as well, in explaining how some of these, blockchain technologies and programmability of currency and so on and so forth, the various benefits you would gain with a digital dollar. What are those benefits? How is that different from things like FedNow, the faster payment system the Fed's going to be rolling out at some point. So there's a huge education challenge, and really, I think it all starts with understanding that there's big differences between central bank currency, which you can think of from a retail perspective as the coins and banknotes in your pocket, and commercial bank money, which is when you look up at your account balance in online banking, what's the bank showing you have. That's commercial bank money. That is bank manufactured money that is lent into existence, and it has different properties around settlement finality and other characteristics than central bank money. So we've got a lot of work to do on the education side, for sure.
I'd like to think I want to just comment on something you said, Garrett, which is, I'm a big believer that sort of private sector actors who innovate with software are going to create products and services and experiences that hundreds of millions and billions of people fall in love with. And that's actually just going to be the education.
So given the speed of the digital dollar now, do you think that the government would work with private sectors or existing stablecoin technology to accelerate that process?
I think so. I mean, and it really depends on where you are around the world. There are a couple of key things to state on this. So the first is that the largest scale global regulatory response to this problem space is specifically to come up with a set of policy frameworks for working with the private sector. The G20, which is the collection of the 20 most largest economies in the world, the financial ministers and key regulators of the G20, the Financial Stability Board, have been hard at work for the last year, building a set of policy guidelines for G20 members for how to regulate global stablecoin arrangements. They're not sitting around saying, how do we create a digital currency? They're saying the private sector is here, the private sector is innovating, and we just want to make sure that when these products and services are brought to market at scale, as they are beginning to, and certainly in 2021, we expect to see these reach hundreds of millions, if not billions of people, make sure that they're handled safely. And so I think that's exactly what's happening, is the public sector is very actively working with the private sector, including the US government, including international governments around the world, to figure out how to make this work. And so, the dominant theme today is public-private coordination, and that's happening through the FSB. And I'm very encouraged by that. And then I would just say, even just more domestically in the United States, the U.S. Treasury and the key banking regulator of the U.S. Treasury, the OCC, that oversees national bank and national bank charters, Brian Brooks. I had the pleasure of working closely with Brian on establishing Center Consortium, on establishing USDC. He's now at the OCC and is I think quite constructive about how the Treasury Department can work with the crypto industry, how it can work with leading fintechs that are innovating in this space. He's published extensively publicly on the private sector leading in the digital dollar space. And so I think you had that there. And as we saw yesterday, I mean, there's certainly more willingness to hear about this, at least in Senate committees.
Garrick, I want to talk more about regulatory hurdles that might remain and the travel rule, FATF, that just went into effect this month, where sender and recipients need to be identified. How do you think stablecoins will be complying with this?
Yeah, so regulation. Jeremy, have we talked about regulation through the years? It never comes up, does it? Yeah, so I guess, let me step back from anything specific and just say, I think regulators, have been criticized through the years for various things, perhaps rightfully so in some cases. I think oftentimes they're some of the more unsung heroes in the story of cryptocurrency. I think there's been a lot of things that have been done well in certain jurisdictions in particular. But all this is still evolving. And the thing with regulation, like the travel rule, is look, as cryptocurrency, and I've said this for years, as it grows in use and becomes more important, more integrated with the traditional financial system as we're seeing, it's inevitable we're going to see it more regulated in some way, shape, or form. And I think designing regulations that allow innovation, of course, to continue to foster and occur, but also safeguard, financial stability and consumers and so on is obviously very important. So, things like the travel rule, I think the positive way of looking at it is that, this is a way in which regulators are comfortable with crypto assets continuing to play in this space. You still hear people like Jim Rogers just last week, co-founder with George Soros of the Quantum Fund, expressing this view that, look, if cryptocurrencies ever get too big, regulators will simply eliminate them. And I think things like the travel rule, the fact that we have the Chicago's futures markets, the fact that we have an evolving body of regulations that's allowing cryptocurrency space to play and grow, is really the counter argument to that view expressed by Rogers, which is shared, I know, by other institutional investors who are kind of sitting on the sidelines because they think the end game for crypto is that it simply gets squashed if it ever goes beyond, it's still relatively small, tens of millions of users. I don't agree with that, obviously. And so I think these kinds of rules are necessary. Of course, they're going to impact negatively some companies. We've seen some firms shut down in the Netherlands and elsewhere. Business models have to adjust, but that's just part of playing the game, is my view. And
your view on programmatic stablecoins like DAI?
Well, I think I don't think of DAI as a programmatic stablecoin. I think of Maker as a margin lending facility. So effectively, it is a decentralized margin lending facility. Its biggest competition is Compound. Effectively what you're doing is you're depositing and locking up crypto assets, and you're getting issued a token that is, pegged at $1, but effectively you're borrowing dollars against collateral that you post. So I think that's really maybe more how to think about it. Similarly, you have the ability to lock up different forms of collateral in Compound and borrow dollars as well. So increasingly, these are different takes on decentralized credit and lending markets that are decentralized. And I think fascinating. I think we're in the very early stages of their development. There's lots of analogies and metaphors and so on that people can use, but I like to harken back to, when eBay came out and people were selling Beanie Babies, and people were like, who's going to go on these peer-to-peer marketplaces and sell things to each other, and that's never going to work for the kinds of commerce that we have, and those peer-to-peer markets, which is really what eBay was. It was a centralized platform, obviously, but those peer-to-peer markets were astounding, and Craigslist or what have you, all these different fascinating examples. Peer-to-peer global decentralized financial credit markets has the potential to be quite enormous.
Well, thank you both for being here today. That was very informative. We look forward to keeping in touch and seeing how the market grows. Next up, Philip's back with his review of this week's on-chain data in this week's on-chain reaction.
Thanks, Nisa, and welcome to On-Chain Reaction. I'm Philip Gradwell, the Chief Economist at Chainalysis, here to take you through what's been happening on the blockchain this week. Well, this week the Bitcoin price, it drifted down, dipping below $9,000 at one point, and is now around $9,150. So Bitcoin, it's really been testing that important $9,000 level. On-chain, Bitcoin inflows to exchanges have remained low at around 57,000 Bitcoin per day on average, which is low, but that's actually slightly above what we saw last week. A lot of that Bitcoin that's coming into exchanges is remaining there. We think the Bitcoin exchange balances are continuing to grow. And for me, that weakens the price floor, as there are more people sending their Bitcoin to exchanges looking to sell. It looks like there could be a different story, though, for Ethereum. Here, the balance of ETH on exchanges may have actually declined in the last week, largely due to a big potential withdrawal on the 26th of June. I say a potential withdrawal because that ETH has not yet been received by another service, so it could just remain within the exchange's cold wallet, or it could be a withdrawal into a personal wallet. And if it is a withdrawal into a personal wallet, then there has been a decrease of ETH on exchanges, which in contrast to Bitcoin might put a bit of support under the ETH price. But really, the most interesting thing that happened on-chain this week wasn't to do with exchanges. In fact, there was $1 billion of Bitcoin that flowed into non-exchange services. That's this top right square in the matrix you see here, which was 186% increase on the last 7 days versus the last 30-day average. So really quite an unusual flow of Bitcoin into these other services. We suspect that it was actually flowing into a hosted wallet. So potentially there's a whale who's taking some of their Bitcoin out of circulation and settling in for the longer term. So overall, Bitcoin price and on-chain flows to exchanges, they've had a sideways week. Bitcoin appears to remain on exchanges, suggesting that the price floor is not in yet. But for Ethereum, it could be a different story as the balances of ETH on exchanges look like they have declined. Also, $1 billion worth of Bitcoin moved into non-exchange services. We think it's a whale taking some Bitcoin out of circulation and putting it into storage. Maybe we should take a lesson from them and think that the markets could be a bit quieter in the future. Thanks so much. It's back to you, Nisa.
Thanks, Philip. You've been watching Coinscrum Markets. See you again next week.